Good afternoon, good morning, good evening, whatever time you're listening to this webinar. I do appreciate you for joining me today. Guys, my name is Jay Moore. I'm a CPA. I'm here in Maryland. And today I'm going to be presenting the 10 most expensive tax mistakes that cost business owners thousands. And guys, if you're a business owner, if you are in real estate, if you are someone that is looking to minimize your fair share of taxes, then this is the right place at the right time. So guys, I'm not going to spend a lot of time on formalities. I'm going to jump right into this presentation because that is why you're here. And what I do want you to do is, guys, I want you to keep an open mind because you're going to have to take some notes. And in taking notes, you want to be able to write those notes in such a way that you can go back to your tax advisor, tax preparer, and ask them if they know about some of these things. And especially if you haven't been doing them, ask them to help you to be able to use these strategies that I'm going to reveal to you today in this presentation. Also, what I want you to be thinking about, if you don't have a tax advisor, or if you're saying to yourself, man, I think I may be in the market to switch, I'm going to go ahead and ask you that at the very end, I'm going to give you an opportunity that you can schedule a call with me that's free of charge, so we can have a consultation and I can go through where you are, how you've been operating your business, and be able to help you with, some of these tax strategies, if not all, or others that we may not actually talk about on this webinar. So I hope you're ready, guys. Don't forget, I hope you got your pen and paper. I'm jumping right into the content now. So guys, the number one mistake is failing to plan. Guys, most people don't plan when it comes to taxes. I don't care how good you are. I don't care how good your tax preparer is. On April 15th with the stack of receipts is not going to help you. If you run your own business and you don't know you could use a medical expense reimbursement plan to write off your kids' braces as a business expense, there's nothing we can do if you haven't set up the plan. Guys, Supreme Court Justice William Rehnquist had this to say: there's nothing wrong with the strategy to avoid the payment of taxes. The Internal Revenue Code doesn't prevent that. Tax planning means looking forward to minimize your taxes, not just recording history. What should you do? When you should do it? How should you do it? And tax planning gives you more powerful advantages. First, it's the key to your financial defenses. You have two ways to put cash in your pocket. Financial offense is making more. Financial defense is spending less. And for many of us on this call or watching this video today, taxes are our biggest expense. So it makes sense to focus our financial defense where we spend the most. Sure, you can save 15% on car insurance by switching to Geico. Everybody knows that. But how much will you really save in the long run? And second, tax planning guarantees results. You can spend all sorts of time, effort, and money promoting your business or working on your portfolio, but that can't guarantee results. Or you can set up a medical reimbursement plan, deduct your daughter's braces, and guarantee the savings. Let's start by taking a look at how the tax system works. Then we'll discuss where the new law changes and the rules. The process starts by adding up your income from all sources to calculate total income. Next, you'll subtract a specific adjustments to an income that are available to all taxpayers, whether you itemize or not. Next, you'll deduct your standard deduction or itemized deductions, whichever is greater. Next, you'll consult the tax table brackets to determine your actual tax. Next, you'll subtract any available tax credits. Next, you'll add back any additional taxes like self-employment tax or net investment income tax. Finally, you'll stroke a check to the IRS. If you've done a decent job with your withholding and quarterly estimates, you'll get a small refund. If you've done a great job, you won't owe anything or get anything back. So, start with income. This includes pretty much everything you think the IRS is interested in. earned income from wages, salaries, bonuses, and commissions, profits and losses from your business, interest and dividends from bank accounts, stocks, bonds, and mutual funds, capital gains from property sales, pensions, IRAs, annuity income, alimony and gambling winnings. Even illegal income is taxable. The IRS doesn't care how you make it, they just want their share. The good news is, if you're operating in a legal business, you can deduct the same expenses as if you were running a legitimate business. So if you're a bookie, you can deduct the cost of the cell phone you use to take bets. If you're a bank robber, we'll show you in a bit how to write off your getaway car. All right, so once you've added up total income, it's time to start subtracting adjustments to income. These are a group of special deductions listed on the first page of Form 1040 that you'll take whether you itemize deductions or not. Total income minus adjustments to income equals adjusted gross income, or AGI. Adjustments to income are also called above the line deductions because you take them above the AGI. That number turns out to be pretty important when it comes to major charitable gifts, so keep that in mind. Specific adjustments include IRA contribution, moving expenses, half of your self-employment tax, self-employment health insurance, self-employment retirement plan contributions, alimony you pay, and student loan interest. The Tax Cuts and Jobs Act of 2017 make a couple of changes to this area. First, moving expenses are no longer deductible except for active duty military, changing permanent duty stations. And second, alimony will no longer be deductible to the payer or taxable to the payee for agreements entered after December 31, 2018. All right, so once you total up adjusted gross income, it's time to take your standard deduction or itemized deductions, whichever is more. The Tax Cuts Jobs Act made an important change in this area by essentially doubling those standard deductions. Now, these amounts are already high enough that about 2/3 of taxpayers already take them. The new tax rule should mean that only about 10% of taxpayers will itemize anymore. But there's a trade-off that may end up costing you big time. It used to be that you could take a personal exemption for yourself, your spouse, and each of your dependents. For 2017, that was $4,050 per person, but they are gone entirely now. So let's say you're a married couple filing jointly with no kids. Last year you got a deduction of $12,700 for standard deduction, and you got $8,100 in exemptions, for a total of $20,800. Suddenly, that $24,000 standard deduction doesn't look so generous anymore. If you're a married couple filing jointly with 2 kids, you got $12,700 standard deduction plus $16,200 in exemptions, for a total amount of $28,900 in tax-free income. Now, that $24,000 standard deduction leaves you nearly $5,000 in the hole. The lower rates in expanded child tax credit may or may not make up that difference, but you should know that doubling the standard deduction isn't quite the gift it sounds like at first. So, if your deductions are still high enough to justify itemizing after the new standard deduction, then the higher standard deductions won't help you, but losing your personal exemptions will probably hurt you. All right, but the tax code lets you choose to itemize and deduct a specific set of personal exemptions. These include medical and dental to the extent they exceed 7.5% of your adjusted gross income. State and local income taxes, sales taxes, and property taxes. You used to be able to deduct an unlimited amount here, but the Tax Cuts and Jobs Act limits you to just $10,000 now. Foreign taxes you pay on business or investment income. Mortgage interest, you pay up to $750,000 of acquisition indebtedness on your primary residence. That limit used to be $1 million, but the Tax Cuts and Jobs Act cut this amount down to $750,000. Casualty and theft losses, to the extent they exceed $100 plus 10% of your adjusted income, for losses in federally declared disaster areas, and charitable gifts. You used to be able to write off a category called miscellaneous itemized deductions, which included unreimbursed employee expenses, tax preparation fees, and investment expenses. The Tax Cuts and Jobs Act eliminated those deductions. Tax deductions reduce your taxable income. If you're in the 10% bracket, an extra dollar of deductions cuts your tax by 10 cents. If you're in the 37% bracket, that same extra dollar of deductions cuts your tax by 37 cents. All right. Once you've subtracted your standard deduction or itemized deductions, you'll have taxable income. At this point, the table of tax brackets tells you how much to pay. Here's where the Tax Cuts and Jobs Act makes the biggest change, the one that affects everyone who owes tax. So in 2017, there were 7 tax brackets, starting at 10% and topping out at 39.6%. The new law keeps that 7 bracket structure but cuts most of those rates. There's another important change that you won't see reflected on the chart. In 1985, Washington started indexing elements of the tax code, like standard deductions, personal exemptions, and tax brackets, so that rising inflation wouldn't push taxpayers into higher tax brackets. The IRS has used the Consumer Price Index, or CPI, to measure inflation. However, the new law specifies a different index called the Chained Consumer Price Index. This index assumes that as prices go up and consumers react by choosing cheaper goods, for example, the price of apples goes up, you probably won't stop eating them. But you might switch from Golden Delicious to Granny Smith. If you're a millennial, substitute avocado toast for apples. You get the point, right? The bottom line result here is that the chained or CPI rises more slowly compared to the regular CPI. So switching to chain CPI will function like a small but noticeable annual across the board tax hike. Interesting stuff, right? All right, so finally, you'll subtract any tax credits. These are dollar for dollar tax reductions, regardless of your tax bracket. So if you're in the 15% bracket, $1 worth of tax credits cut your tax by a full $1. If you're in a 35% bracket, an extra $1 worth of tax credit cuts your tax by the same $1. There's no real secret to using tax credits other than knowing what's out there. The biggest change with the Tax Cuts and Jobs Act is the child tax credit. Under the old rules, the child tax credit was capped at $1,000 per child under the age of 17. The credit phased out by $50 for each $1,000 of modified adjusted income above $75,000 for single filers, or $110,000 for joint filers. Modified adjusted gross income equals regular adjusted income plus a seemingly random laundry list of items like non-taxable municipal bond interest, student loan interest, half of your self-employment tax, and any deductible college expenses. If the credit was more than your actual tax bill, you might qualify for an additional tax credit to the extent of any earned income above $3,000. Make you wish you could fill out your taxes on a postcard, right? All right, so the new rules double the credit to $2,000 per child. They raised the threshold for phasing it out to $200,000 for single filers and $400,000 for joint filers. And they raised the refundable portion to $1,400 and index that amount for inflation. So much for taxes you can fill out on a postcard, right? Remember, we've talked about those disappearing personal exemptions. The worst hit taxpayers are those with children. The new child tax credit rules restore some of these or those lost benefits. All right, so we're not done. As the television infomercials say, but wait, there's more. You may also owe self-employment tax, which replaces Social Security and Medicare for sole proprietors, partnerships, and LLCs. You might also owe state and local income and earnings taxes. There's also a 3.8% unearned income medical contribution on investment income for single taxpayers earning more than $200,000 and joint filers earning more than $250,000. For purpose of this rule, investment income includes interest, dividends, capital gains, rental income, royalties, and annuity distributions. Finally, there's alternative minimum tax, which requires you to throw out some of the most valuable deductions like state and local income taxes and recalculate your bill all over using slightly lower rates but a bigger base. Which amount is higher, regular tax or AMT? Pay that one. Thank you very much. The Tax Cuts of Jobs Act raises the AMT exemption, which should help shield more taxpayers from that particular delight. If you have household employees, you may need to pay a nanny tax on their earnings. That might not sound important now, but if you're ever nominated to serve in the president's cabinet, you can be sure the Senate will ask you about it. The bottom line here is this. Tax brackets aren't as simple as they might appear. Your actual tax can be quite a bit higher than your supposed tax bracket. All right, so here's the bottom line. You lose every time you spend after-tax dollars that could have been pre-tax dollars. Let me repeat that. You lose every time you spend after-tax dollars that could have been pre-tax dollars. We're going to spend the rest of the presentation talking about how to turn after-tax dollars into pre-tax dollars. In the end, there are four main buckets of strategies that you can use to cut your tax bill. You've got timing-based strategies like using 401k deferrals to shift today's tax bill to tomorrow. You've got income shifting strategies to move taxable income to lower bracket taxpayers like your children. Code-based strategies like the 105B that may let you deduct your family's medical bills as a business expense. And we got product-based strategies like managed accounts and insurance. We'll be focusing today on timing, strategy, and code-based strategies, but it's worth knowing that these are the four main buckets. All right, so the second big mistake is nearly as important as the first, and that's fearing rather than respecting the IRS. What does the kind of tax planning we're talking about do to your odds of being audited? The truth is, most experts say it pays to be aggressive. That's because overall audit odds are so low that most legitimate deductions aren't likely to wave red flags. See, audit rates are actually at historic lows. For 2015, the overall audit rate was just 1 in every 100 return. The IRS primarily targets small businesses, especially sole proprietors, and cash industries like pizza parlors and coin-operated laundromats with opportunities to hide income and skim profits. In fact, they publish a series of audit guides that you can download from their website that tell you exactly what they're looking for when they audit you. Take a look at the bottom of the chart. You'll see that the IRS audits just 0.5% of S corporations and partnerships. If you're really worried about being audited, you might consider reorganizing your business to help fly under the radar. The next mistake is choosing the wrong entity. Most business owners start out as sole proprietors. Then as they grow, establish a limited liability company or corporation to help protect them from business liability. But choosing the right business entity involves all sorts of tax considerations as well. And many business owners are operating with entities that may have been appropriate when they were established, but just doesn't work as effectively now. I can't make you an expert in business entities, but I can help you diagnose some common problems that might be costing you taxes you just don't have to pay. Let's start with one problem I see a lot of business owners make. That's paying too much self-employment tax. Most businesses start out taxed as a sole proprietorship. Even if the owner established an LLC, they usually elect the default tax treatment, which is a disregarded entity. This means the business is taxed as a sole proprietorship. The owner will report the business net income on Schedule C. The business net income is subject to regular income tax. The business net income is also subject to self-employment tax. For 2018, this is 15.3% on the first $128,400 plus 2.9% on everything else, plus a potential 0.9% on amounts over $200,000 for individual filers or $250,000 for joint filers. Lots of accountants dismiss the self-employment tax, especially once you've exceeded the $128,400 Social Security wage base, but it adds up fast. So in our example, we have an owner netting $80,000 and paying $11,304 in self-employment tax before they even look at their regular income tax. While we're at it, it's worth mentioning that the rules work especially the same if you're a partner in a partnership. That is to say, you pay regular income tax on your partnership income and self-employment tax on it as well. Now, I know what you're thinking. You're thinking, this isn't really a problem, is it? After all, self-employment tax is what you pay in lieu of Social Security tax. The money goes into the Social Security Trust Fund, where serious-looking bankers wearing serious-looking glasses and serious-looking Brooks Brothers suits are carefully investing it for your future retirement, right? Doesn't it feel good to have a trust fund? No. Sorry to say, that's not how it really works. Taxes go in and benefits come out, right? Any excess gets invested in treasury bonds, which means Uncle Sam starts spending it right away. I'm not going to go into the politics of entitlement spending or solvency projections or means testing proposals or anything like that. But it's safe to say that not a lot of business owners are planning on retiring on Social Security for much of their retirement income. Establishing an S corporation solves that problem by dividing your net income into two parts, one of which is not subject to employment tax. Here's how it works. The corporation will pay you a salary for the service you perform as an employee. You'll get a W-2 for that amount, just like any other employee. The rest of the income will pass through to your personal income tax as a dividend. You'll pay regular income tax on both halves, the salary and the dividend, just like you did with the sole proprietor income. You'll pay employment tax in the form of FICA withholding on the amount you take as salary. It's the same 15.3% up to $128,400 Social Security wage base, plus 2.9% on anything above that, plus 0.9% of wages above $200,000 for individual taxpayers and $250,000 for joint filers. But here's where the magic happens. You'll avoid employment tax entirely on the amount that passes through to you as a dividend. Let's take a quick look at some numbers to see what sort of savings we can create. A minute ago, we looked at a business owner earning $80,000 as a sole proprietor, paying $11,304 in self-employment tax. If we establish an S corp or cause an existing LLC taxed as a sole proprietor to make an S election and pay a $40,000 salary will save $5,184 in employment tax. This is especially valuable because we're simply eliminating a tax. We're not asking you to put $5,184 into a retirement plan and then deduct it, or take $5,184 and buy new equipment, then deduct it. We're simply avoiding that $5,184 in self-employment tax. Now let's look at the fine print, because I already know what you're thinking. Why not pay zero salary or a ridiculously low amount like $1,000 a year? Well, the rules require you to pay yourself a reasonable salary for the work you do as an employee for the corporation. That's not always easy to determine. The IRS and tax court look at several factors when there's a dispute over reasonable compensation. These include the nature of business. Professional service firms are more dependent on the owner's personal effort. The employee qualifications, responsibilities, time devoted to the business, compensation compared with non-shareholder employees or previous years, amounts comparable businesses pay for comparable services, compensation as a percentage of corporate sales, corporate profit, and total distributions. Every year, the IRS Statistics of Income Division publishes spreadsheets reporting all sorts of mind-numbing statistics. These include the average amount of salary that S-Corp owners in aggregate pay in the form of officer compensation versus the amount they take as income dividends. For 2013, that percentage was 32.13%. Now, I'm absolutely not suggesting you take that percentage as any sort of guidance or safe harbor. However, I do want you to see that using the S-Corp to minimize employment tax is a well-established mainstream planning strategy. If you use the RC report service to help, you can use a service called RC to help you determine reasonable compensation. That is a service that we can actually help you with. Here's something else. You'll probably like this. Remember that chart of audit odds we looked at a few minutes ago? Let's take another look. Organizing your business to be taxed as an S-Corp can significantly lower your risk of getting audited. For 2014, the Schedule C audit percentages varied from 0.9% for returns grossing up to $25,000 to 2.4% for returns grossing $100,000 to $200,000. S-Corp odds, in contrast, were just 0.4%. That's less than 20% of the highest Schedule C odds. Okay, let's cover some nuts and bolts. There are two ways to skin this particular cat here: an actual corporation or limited liability company. Either way, you've got to register the entity with the state, then get an employer ID number, then file the actual election, which you make on Form 2553. The filing the S election is pretty straightforward. I mean, you could, like anybody can fill that out. Once the S Corp is all official, you'll have some ongoing paperwork requirements. You'll need to start filing payroll returns for yourself. This may not be a big deal if you're already doing it for if we're already doing it for you. You also need to manage state and local unemployment, workers' compensation premiums, adjusted, for your own estimated taxes to reflect the amounts you'll be withholding from your paycheck. At the end of the year, you'll need to prepare W-2s, and Form W-3, along with a federal unemployment return and various state and local returns. You also need to follow some state formalities for your corporation or LLC. These may not seem important, but if you ever wind up getting audited or sued, you'll be glad you can show you dotted your I's and crossed your T's. Now let's talk about the biggest change the Tax Cuts and Jobs Act of 2017 makes for most business owners. A new kind of income from pass-through businesses was created. Some background here. The tax code has always recognized that there are different kinds of income and treated those kinds of income differently. Ordinary income is what you earn from your work or your business. If you earn a salary from a job, your spouse loses money in a business, you can net those two amounts against each other. If you draw a pension or IRA, that's ordinary income too. Ordinary income is taxed at ordinary rates. All right, so investment income is income you earn from your portfolio. And some of it, like taxable interest income, is taxed at ordinary income tax rates, but different kinds of investment income can be taxed at different rates. Qualified corporate dividends, for example, are taxed at special rates capped at 20%. Long-term capital gains from property held for more than 1 year are capped at 20%. And investment income is subject to 3.8% net investment income tax if your AGI exceeds $200,000 for single filers and $250,000 for joint filers. Now, if you have capital losses in a year, you can subtract them from your capital gains. And then you can subtract up to $3,000 of net capital losses against your ordinary income. But if your net capital losses is more than $3,000, you have to carry the remainder forward for future years. So to at least that extent, investment income is walled off into its own little silo. But in the mid-'80s, taxpayers had figured out a way around that wall. They discovered they could use borrowed money to increase their bases in investments like real estate, oil and gas, and equipment leasing, and write off huge paper losses. Well, in excess of what they had actually invested. They used those losses to offset their ordinary income from salaries and businesses, as well as investment income from their investment portfolios. That was great for taxpayers, of course, especially with marginal rates hitting 70%. But it wasn't good for the U.S. Treasury. So in 1986, Congress created a new category of income called passive income from activities where you don't materially participate. The 1986 rule said that you can write off passive losses against passive income, but not generally against ordinary income or investment income. There's a real estate loss allowance up to $25,000 of rental property losses. But that phases out starting at $100,000 of adjusted income. And so-called real estate professionals who qualify under special rules can deduct passive real estate losses against ordinary income. But for the most part, the 1986 rules were walled off passive income and losses into a third silo. Now, Congress has created a fourth silo called qualified business income. Here's why they need to do that. The Tax Cuts and Jobs Act lowered the top tax on C corporation income from 35% to 21%. That's a whole lot less than the maximum 37% tax on pass-through income from sole proprietors and partnerships and S corporations. To equalize the tax treatment between taxable and pass-through businesses, the Act defines the new qualified business income and lets you deduct 20% of that income, calculated on an activity by activity basis from your taxable income for the year. QBI includes net business income from sole proprietorships, partnerships, S corporations. It also includes pass-through income from real estate investment trusts, publicly traded partnerships, and qualified agricultural co-ops. But it doesn't guarantee payments or W-2 wages you draw from your business. It also doesn't include investment income. Most taxable dividends, other than REITs or co-ops, investment interest income, short-term or long-term capital gains commodity, or foreign currency, etc. However, there are three important limits to this new deduction. Got to pay attention here. Sorry about that. Let's get my place here. It says, first, for 2018 taxable income, after adjustments to income and itemized deductions, is over 100. If it's over $157,500 or $315,000 for joint filers, your QBI deduction for each activity is limited to the greater of 50% of your W-2 wages timely paid on behalf of that activity, or 25% of the W-2 wages plus 2% of the initial cost immediately after acquisition of all tangible property placed in service on behalf of that activity. You can count the initial cost of the property towards this amount for 10 years. All right, so here's an example real quick. You own 20% of an S corporation that pays $500,000 in W-2 wages and has $200,000 of property in service. Your QBI is greater of $50,000, which is 50% of your 20% share of the $500 wages, or $26,000, 25% of your 20% share of the $500,000 in wages, plus 2.5% of your 20% share of the $200,000 in depreciable property. This may mean that careful planning is required to maximize your deduction if your taxable income before subtracting QBI is enough to phase out the deduction. Second, if your QBI comes from a specified service business, meaning medicine, law, accounting, actuarial science, financial services, consulting, performing arts, athletics, or any business that relies on the reputation or skill of one or more employees, your deduction for that activity phases out as your taxable income rises from $150,000, $500 to $207,500 for single filers, or $315,000 to $415,000 for joint filers. This may mean that careful planning is required to define specified service income activities from non-service activities in order to make the most of your opportunity here. Third and finally, the overall QBI deduction is limited to 20% of your taxable income in any particular year. There's no provision for carrying out any unused deduction. However, if your QBI for the year is below zero, you can carry the loss forward to the next taxable year. The new rules suggest several ways to maximize the new benefit. And honestly, the more time tax lawyers and accountants spend looking over these rules, the more ideas they'll come up with. When critics of the tax bill say it will encourage gaming the system, this is the provision they're talking about. This is ground zero for the games. I realize this is going to sound self-serving, but this really isn't do-it-yourself planning. Just because you can buy a tool to do something for yourself instead of hiring a pro to use it doesn't mean you should. If you go to Amazon and search for, orthopedic bone saw, you'll probably find them for under $20. Take a look. Seriously, it's terrifying. But just because you can buy the tool cheap, it doesn't mean you should be setting your kids broken bones. Want to hear something funny? Here's what the Congressional Conference Committee responsible for the final text of qualified business income provisions said in their report. It is not anticipated that individuals will need to keep additional records due to the provision. It should not result in an increase in disputes with the IRS, nor regulatory guidance be necessary to implement this decision. Do you think they actually believe that? Or is it just something they told themselves to feel better about unleashing a hurricane of new uncertainty into the system. All right. Number 5, you've got the wrong retirement plan. So we're going to talk about it this way. If you're looking to save more than $5,000, $5,500 limit on your IRAs, you have 3 choices, right? You got simplified employee pension or SEPs, simple IRAs, or 401ks. I'm not here to make you an expert on retirement plans, but I can help you decide pretty quickly if the plan you have is right for you, or if you should be looking for something more suited to your specific needs. So bear with me. Even if the next few slides look intimidating, these are some powerful strategies. All right, so the SEP is the easiest plan to set up because it's just a turbocharged IRA. If you're self-employed, you can contribute up to 25% of your net self-employment income. That amount doesn't include SEP contribution itself, which it means you can actually contribute 20%. If your business is incorporated and you're salaried, you can contribute 25% of your covered compensation, which is roughly the same as your salary. The maximum contribution for 2018 is $55,000. If you got employees, you'll have to contribute for them too. You generally have to contribute the same percentage for your employee as you do for yourself. However, you can use what's called an integrated formula to make extra contributions for higher incomes. The money goes straight into employee IRA accounts. There's no additional administration or paperwork required. The SEP is easy to adopt, easy to maintain, and flexible. There's no money to contribute. You just don't contribute. But the contribution is limited to a percentage of your income. If you set up an S corporation, the limit of self-employment tax, you'll also limit your your SEP contribution. So many tongue ties here. Sorry about that. All right, so the next step, set up your retirement plan ladder is the simple IRA. This is another turbocharged IRA, lets you contribute up to $5,500 limit. It's available for employers with 100 or fewer employees earning $5,000 or more per year. You and your employees can contribute $12,500. If you're 50 or older, you can make an extra $3,000 catch-up contribution. If your income is under $50,000, that may be more than you could sock away with a SEP. That's because $12,500 is more than 25% of what you could contribute to a SEP. But you have to match everyone's deferral or make profit-sharing contributions. You can match everyone's contribution dollar for dollar up to 3% of their pay, or make a profit-sharing contribution equal to 2% of everyone's pay, whether they defer or not. If you choose to match, you can reduce it as low as 1% for 2 years out of every 5. The money goes straight into employee IRAs. You can designate a single financial institution to hold the money, or let your employees choose. Like with SEP, there's no setup charge or annual administration fee. The simple IRA may be the best part-time or sideline business earning less than $50,000. So if you have a sideline business earning less than $50,000, this is definitely a good way or a good option. You can also hire your spouse or children, and they can make simple IRA contributions. We'll be talking more about those strategies in a few minutes. All right, so the next step, the next step up the ladder is the 401k. Most people think 401ks as retirement plans for bigger businesses, but you can set up what's called a solo or individual 401k for yourself. The 401k is a true qualified plan. This means you'll set up a trust, adopt a written plan agreement, and choose a trustee. But the 401k lets you contribute far more money, far more flexibility than either the SEP or the simple. You and your employees can defer 100% of your income up to $18,000 per year. If you're 50 or older, you can make an extra $6,000 catch-up contribution. You can choose to match your employee's contribution or make profit sharing contributions up to 25% of their pay. That's the same percentage you can save in your SEP on top of the $18,000 deferral. The maximum contribution for 2018 is $55,000 per person, plus any catch-up contributions. You can offer yourself and your employees loans and hardship withdrawals and all the bells and whistles the big boys offer their employees. 401ks are generally more difficult to administer. There are anti-discrimination rules to keep you from suffering or stuffing your own account while you stiff your employees. So if your plan gets top heavy, which means the value of key employee accounts is more than 60% of the plan balance, you'll have to make 3% required contribution for non-key employees. If you operate your business by yourself or yourself and your spouse, you can set up what's called an individual 401k with less red tape. So don't rule it out just because you're not a Fortune 500 business. There are a couple of variations of the 401k that might make sense. The simple 401k has much of the same rules as the simple IRA, except it involves a genuine 401k trust account. The Safe Harbor plan is designed to avoid top-heavy testing and rules. It works the same as the regular 401k. However, you'll have to match employee contributions up to 4% of their pay or make 3% profit sharing contribution on behalf of everyone, whether they make deferrals into the plan or not. So this makes sense for businesses like restaurants and retailers who have a high number of lower paid employees who tend not to participate in qualified plans. If you're older and you want to contribute more than a $54,000 limit for SEPs or 401ks, consider a traditional defined benefit plan. Right? Defined benefit plans let you guarantee up to $250,000 in annual income starting at age 62. You can contribute and deduct as much as you need to finance that benefit. You calculate those contributions according to your age, your desired retirement age, your current income, and various actuarial factors. Defined benefit plans have required annual contributions, but you can combine a defined benefit plan with a 401k or SEP to give yourself a little more flexibility. Finally, you'll need an actuarial analysis every year to evaluate your progress towards your goals. This may mean higher or lower contributions than you initially anticipated, depending on how well your investments perform. All right, so a 412E3 plan, which used to be called a 412I plan until Congress changed the code, is a defined benefit plan funded entirely with life insurance or annuities. These investments generally return less than traditional stocks and bonds portfolio, but the insurance company guarantees your results. So the trade-off may make sense, especially for conservative investors. And those lower returns mean you can stuff more money into the plan, in some cases twice as much or more than in a traditional defined benefit plan. A 412E3 is also less expensive to administer because there's no actuarial certification required. However, there's a danger that the plan could actually let you stuff too much money into the plan and face penalties for overfunding. So you have to be very careful here. Like I said a few minutes ago, I'm not here to make you an expert in retirement plans. We haven't even touched on strategies like cross-testing, cash balance plans, and non-qualified alternatives like insurance-based retirement plans, closely held insurance companies, or charitable remainder trust. I just want you to be aware or make you aware that there are probably far more options out there than you realize. And if you don't sit down to explore those options, you could be missing out on some amazing savings. All right, here we go. Number 6, failing or missing family employment. Missing family part, hiring your children and grandchildren could be a great way to cut taxes on your income by shifting it to someone who pays less. Yes, there's a minimum age, for now at least. They have to be at least 7 years old. I've seen recommendations that you can hire your younger children to serve as models for advertising, but I'm not aware that of that particular strategy has been blessed by the IRS or the courts. Their first $12,000 of earned income is taxed at zero. That's because it's the standard deduction for a single taxpayer. If you claim them as your dependent, their next $9,525 is taxed at just 10%. So you can shift a lot of income downstream. All right, you have to pay them a reasonable wage for the service they perform. The tax court says a reasonable wage is what you'd pay a commercial vendor for the same service, with an adjustment made for the child's age and experience. So if your 12-year-old son cuts grass for your rental properties, pay him whatever a landscaping service might charge. If your 15-year-old helps keep your books, pay him a bit less than a bookkeeping service might charge. Does anyone have a teenager who helps with their website? What would you pay a commercial designer for that service? All right. So to audit-proof your return, write out a job description and keep a timesheet. Pay by check so you can document the payment. You have to deposit the check into an account in the child's name. But it doesn't have to be his pizza and Nintendo fund. It can be a Roth IRA for decades of tax-free growth. It can be a Section 529 college plan, or it can be a custodial account that you control until age 21. Now, you can't use money in a custodial account for your obligations of parental support, but private and parochial school aren't obligations of parental support. Sleepaway summer camp isn't an obligation of parental support. All right, so let's say your teenage daughter wants to spend 2 weeks at horse camp. You can earn the fee yourself, pay tax on it, and pay the camp with after-tax dollars. Or you can pay her to work in your business, deposit a check in her custodial account, then as a custodian, stroke the check to the camp. Hiring your daughter effectively lets you deduct her camp as a business expense. If you hire your child to work in an unincorporated business, you don't have to withhold for Social Security until they turn 18. So this really is tax-free money. You'll have to issue them a W-2 at the end of the year, but this is painless compared to the tax you'll waste if you don't take advantage of this strategy. Now let's talk about healthcare costs, number 7. All right. Surveys used to show that taxes used to be the average business owner's biggest concern. Now it's rising healthcare costs. If you pay your own health insurance, you can deduct it as an adjustment to income on page 1 of 1040. If you itemize, you can deduct unreimbursed medical and dental expenses on Schedule A if they total more than 7.5% of your adjusted gross income. But most of us don't spend that much on healthcare, so we just lose those deductions. But what if there was a way to write off medical bills as business expenses so you don't lose them because of the 10% floor? There are a couple ways you can do that. The first one is called a medical expense reimbursement plan, or Section 105 plan. The Section 105 plan is an employee benefit plan. That means somebody needs to qualify as an employee. The problem is if you run your business as a sole proprietor, which includes a single member LLC, a partnership, or an S corporation, you're considered self-employed and you can't get the benefits from the plan. So you have to figure out another way to qualify. So if you're a sole proprietor or single member LLC, or LLC taxed as a proprietorship, and you're married, you can hire your spouse. If you're a partner in a partnership or LLC taxed as a partnership, You can hire your spouse so long as they don't own more than 5% of the business. If you're a shareholder or member in an entity taxed as an S corporation, you don't qualify and your spouse doesn't qualify. Your best bet in that situation is to segregate part of your income into a separate entity, such as a proprietorship or C corporation, and run the plan through that entity. Finally, if you run your business, or even just a part of your overall business as an entity taxed as a C corporation, you don't qualify as an employee all by yourself. By the way, you can also use a 105 plan for family members other than your spouse. Let's say you're a single mom working as a real estate agent. You can hire your teenage child and use the plan to pay for their eyeglasses, braces, or other medical costs. You can even hire a retired parent to help cover their medical costs. All right, so the plan has to cover all eligible employees. You can't just cover yourself or your family and exclude everyone else. However, there are several safe harbors you can use to limit coverage. Specifically, you can exclude employees under age 25, employees working less than 35 hours per week, employees working less than 9 months per year, and employees who have worked for you for less than 3 years. There are a couple of other exclusions for larger employees, like union workers covered by a collective bargaining agreement. And the IRS really doesn't pay a whole lot of attention in this area, although the Department of Labor does. But the fact remains that you don't have to cover all employees. So if you have non-family members and can exclude them under one of these rules, the 105 plan may not be appropriate for you. All right, so now for the benefit. Once you qualify, the plan lets you reimburse your employee for all medical expenses they incur for themselves, their spouse, and their dependents. Let's say you're a married sole proprietor and you hire your spouse. You can reimburse them for all medical expenses they incur for themselves, their spouse, which means you, and your dependents. Now you've taken what would have probably have been a non-deductible personal expense and converted it into a business expense. You've avoided that 7.5% floor on itemized deductions. And if you pay self-employment tax on your net income, you'll even avoid paying self-employment tax on the money you deduct through the 105 plan. That's another 15.5%, 15.3%, or 2.9%, or 3.8%, depending on your self-employment income. What exactly can you deduct? Well, pretty much everything you can think of. This includes all expenses you see listed here: major medical insurance, long-term care insurance, medical Part B and D coverage, the Medigap insurance, co-pays, deductibles, prescriptions, dental, vision, chiropractic, big ticket items like braces for your kids, LASIK surgery for your eyes, fertility treatments, and special schools for learning disabled children. You can even reimburse for over-the-counter medications, vitamins, herbal supplements, and medical supplies, so long as they're actually prescribed by a physician. The best part is, this is money you'd spend anyway. Whether you get to deduct it or not, you're just moving it from non-deductible place on your return to a deductible place on your return. So here's the paperwork. You need a written plan document, which we can provide for you. You need to make sure the benefits you pay are reasonable compensation for the work your employee does. If a teenager stuffs a few envelopes for you, the IRS will have a hard time believing a full set of braces is reasonable compensation for that little work. You need to verify the work your employee does in order to establish the benefits you pay are reasonable compensation. This is a big hot button here with the IRS and tax court. Finally, you'll need to establish a paper trail to verify payment. This means tracking expenses, of course. It also means reimbursing your employee out of the business or paying their expenses directly out of the business. It's not just to pay your family's expenses out of personal funds, total them up, and to deduct them at the end of the year. A couple of recent tax court cases have established that you really do need to establish a business link to those expenses. There's no need for an outside third-party administrator. However, IRS rules state that employees can't self-certify their own expenses. There's no special reporting required. You'll report reimbursement as employee benefits on Schedule C, Form 1065, or 1120. You'll save the income tax and self-employment tax. There are no pre-funding requirement. You don't have to open a special account like a health savings account or flex spending account. You don't have to decide ahead of time how much to contribute, and there's no use it or lose it rule. The plan is really just an accounting device that lets you characterize your family medical bills as business expenses. All Section 105 sponsors must file Form 720 to report and pay a patient-centered outcomes research institute fee of $2.17 per participant by July 31 of the year following the plan year. Ordinarily, this form is filed quarterly. However, if an employer owns no other excise taxes, they may file annually. All right. So if a medical expense reimbursement plan isn't appropriate, consider the new health savings accounts. These arrangements combine a high deductible health plan with tax-free savings account to cover unreimbursed costs. To qualify, you need a high deductible health plan with a deductible of at least $1,300 for single coverage or $2,600 for family coverage. Neither you nor your spouse can be covered by a non-high deductible health plan or Medicare. The plan can't provide any benefit other than certain preventative care benefits until the deductible for the year is satisfied. You're not eligible if you're covered by a separate plan or rider offering prescription drug benefits before the minimum annual deduction is satisfied. Once you've established your eligibility, you can open a deductible savings account. You can contribute up to $3,450 for singles and $6,900 for families. You can use it for most kids' health insurance, including COBRA, continuation, and long-term care premiums. You can also use it for most of the same expenses as the Section 105 plan. The health savings account isn't quite as powerful as the 105 plan. You've got specific dollar contribution limits, and there's no self-employment tax advantage. But health savings accounts can still cut your overall healthcare costs. All right, number 8. The home office deduction is probably the most misunderstood deduction in the entire tax code. For years, taxpayers feared it, raised an automatic audit flag. But Congress has relaxed the rules, so now it's far less likely to attract attention. First, let's talk about how you qualify for the home office deduction in the first place. Your home office qualifies as your principal place of business if you use it exclusively and regularly for administrative or management activities of your trade or business. 2, you have no other fixed location where you conduct substantial administrative or management activities of your trade or business. This is true even if you have another office, so long as you don't use it more than occasionally for administrative or management activities. All right, you have to use your office regularly and exclusively for business. Regularly generally means 10 to 12 hours per week. To prove your deduction, keep a log and take photos to record your business use. You can claim a workshop, studio, or separately identified space you use to store products or sample. The space doesn't have to be an entire room. If you use it for more than one business, both have to qualify to take the deduction. Once you've qualified, you can start deducting expenses. If you're taxed as a proprietor, you use Form 8829. If you're taxed as a partnership or corporation, there's no separate form, which helps you fly under the radar. First, you'll need to determine the business square footage of your home. You can divide by the number of rooms if they are roughly equal, or calculate the exact percentage of square footage. You can exclude common areas like halls and stairs to boost that business percentage. All right, so next, you'll deduct your business use percentage of rent, mortgage, interest, and property taxes. You'll depreciate the business use percentage of your home's basis, excluding land, over 39 years as non-residential property. Finally, you'll deduct your business use percentage of utilities, repairs, insurance, garbage pickup, and security. If business use percentage for specific expenses differ from business use percentage for overall home, such as high electric bills for the home office equipment, you can claim the difference as direct expenses. It says claiming a home office can boost your car and truck deductions. That's because it eliminates commuting miles for business. All right, you can use your home office expenses to shelter profits, but not below zero. If your home office expenses exceed your net business income, you can carry forward those excess losses to future years. When you sell your home, you have to recapture any depreciation you claimed or could have claimed after May 6, 1997. You can still claim the $500,000 tax-free exclusion for your home office space unless it's a separate dwelling unit. If this all seemed like too much work, there's a new safe harbor method that lets you claim $5 per square foot up to 300 square feet of qualifying home office. However, using the safe harbor method might not let you claim nearly as much as the traditional method. We can help you walk through the calculations to see which method is best for you. By the way, if you're one of those people who still believes the home office is an automatic red flag, ask yourself this: why would the IRS offer a safe harbor method for claiming it if they didn't want you taking it in the first place? All right, number 9, missing car and truck expenses. So, I don't want to take too much time here, but I do want to point out the common mistake clients make with these expenses. All right. So are you detecting a pattern here that deduction is the same for everyone no matter what we drive? Do you think that we all spend all the same to operate our cars? It might surprise you to see how much it really costs to operate your car. And it's not actually 54 cents per mile. Every year, AA publishes a vehicle operating cost survey. Costs vary according to how much you drive. But if you're taking the standard deduction for a car that costs more than 54 cents a mile, you're losing money every time you turn the key. If you're taking the standard deduction now, you can switch to the actual expense method if you own your car, but not if you lease it. You can't switch from actual expenses to mileage allowance if you've taken accelerated depreciation. So look, number 10, let's finish up with some fun details or fun deductions for business meals. All right, so the basic rule is that you can deduct costs for meals with a bona fide business purpose. This means clients, prospects, referral sources, business colleagues, and let me ask you, when do you ever eat with someone who's not a client, prospect, referral source, or business colleague? If you're in a business like real estate, insurance, or investments, where you're marketing yourself, the answer might be never. Be as aggressive as you can with what you define as bona fide business discussion. All right. So the general rule is this: you can deduct 50% of your meals so long as they aren't lavish or extraordinary. The IRS knows you have to eat, so you can deduct it all, but they'll meet you halfway. I'm sorry, you can't deduct it all, and they'll meet you halfway. How many of you entertain at home? Do you ever discuss business? Are you deducting those meals too? There's no requirement that you eat out. Don't forget to deduct home entertainment expenses too. You used to be able to deduct entertainment expenses if they took place directly before or after substantial bona fide discussion directly related to the active conduct of your business. However, the Tax Cuts and Jobs Act eliminates that deduction entirely. All right, so you don't need receipts for expenses under $75, but you do need to record the 5 pieces of information listed on the screen. So, you need to know, and you should do it as close to daily as possible. The IRS wants to know how much you paid for the meal, the date of the meal, the place where it took place, the business purpose of your discussion, and your business relationship with your guests. You got to keep these records. Guys, now that you see how business owners miss out on tax breaks, let's talk about the biggest mistake of all. I hope you stuck with me to the end. I know it's been a lot of information. I totally understand that. But what mistake am I talking about? As we said earlier, the biggest mistake of all is failing to plan. Have you all heard the saying, if you fail to plan, you plan to fail? Yeah, it's cliche because it's true. Fortunately, our tax coaching service fixes that mistake. We offer true tax planning. We'll tell you what to do, when to do it, how to do it. We start with an initial interview where we'll analyze your current situation. We'll diagnose your tax problems the way your doctor would diagnose a medical problem. Then we prepare a written plan that addresses your family, home, and job, your business, and your investments. We'll even review your previous year's tax returns to see if we can find savings you overlooked. So if you're serious about taking advantage of the strategies discussed today, you owe it to yourself to give it a try. So guys, look, I appreciate you for sticking with me, and hopefully you got a lot of value from this presentation. I know it was a lot of information. What you should do is you can schedule with me. You can schedule a call with me. You can use the link somewhere on the page where you got this video, or you can go back to your tax advisor and you can ask them about all of the information or the notes that you took, asking them how they can help you to gain an advantage when it comes to taxes. Guys, taxes are a wealth building tool, and I want you to do that. So definitely, guys, schedule a call. You see the link. You want to save money. You don't want to overpay. So schedule a call today. The call is free, and we will definitely find a way for you to get more savings, even if it's prospective. If you're small, then that means that maybe we'll be planning because you're growing. But if you've already started earning $100,000, $200,000, $300,000 plus, then I can guarantee you guys, not that I'm going to save you a specific amount, but I can guarantee you that you're going to get a lot of benefit from seeing and knowing that you would save money. So guys, I appreciate you for joining me. My name is Jay Moore, the Healthy Accountant, where I want you to have a healthy business, healthy finances, and a healthy life. God bless you. Take care.